The Federal Reserve is trapped in an impossible situation. Inflation is still running at 3.4%, well above their 2% target. But economic data is weakening. Jobless claims are rising, manufacturing is contracting, consumer spending is slowing. If they cut rates to support the economy, inflation reignites. If they hold rates high to fight inflation, they trigger a recession. There is no third option, and both paths lead to the same place, a crisis that destroys wealth for anyone holding dollar-denominated assets. If you want to understand why the Fed has lost control and what that means for your wealth, subscribe now and see the endgame clearly. Let's establish exactly what the Federal Reserve's mandate is and why they're failing at it. The Fed has a dual mandate from Congress: maximum employment, keep unemployment low; price stability, keep inflation around 2%. For decades, these goals were compatible. When unemployment was high, the Fed cut rates to stimulate the economy. When inflation was high, they raised rates to cool things down. This worked because inflation and unemployment typically moved in opposite directions, the Phillips curve relationship. But that relationship has broken. Right now we have inflation at 3.4%, stubbornly above target; unemployment at 3.9%, rising from 3.4% 6 months ago; GDP growth slowing, manufacturing PMI in contraction, consumer confidence falling. This is the worst of both worlds: stagflation. The economy is weakening, but inflation won't come down, and the Fed's tools don't work in a stagflation environment. If they cut rates to support the weakening economy, inflation stays elevated or accelerates. If they hold rates high or raise them further to fight inflation, they push the economy into recession and unemployment spikes. Both options hurt. This is not a policy debate about the optimal path. This is a trapped position with no good moves. Here's the mechanism that explains why the Fed is trapped and how we got here. For 15 years after the 2008 financial crisis, the Fed ran extremely loose monetary policy: interest rates near zero, quantitative easing, massive balance sheet expansion. This was supposed to be temporary, emergency measures to prevent depression, but it lasted 15 years. Why? Because every time the Fed tried to tighten, 2013 taper tantrum, 2018 rate hikes, markets crashed and they had to reverse course. The economy became addicted to cheap money, asset prices inflated, debt levels exploded, then COVID hit in 2020. The Fed went all in, rates to zero, $5 trillion in QE, unlimited liquidity. This created the inflation we're dealing with now: too much money chasing too few goods. So in 2022, the Fed started raising rates aggressively, from 0% to 5.25% in 18 months, the fastest hiking cycle in 40 years. They assumed this would bring inflation down quickly without crashing the economy. It didn't work as planned. Inflation has come down from 9% to 3.4%, but it's stuck there. It won't drop to 2% because fiscal policy is still loose. The government is running $2 trillion deficits, injecting demand into the economy even as the Fed tries to restrict it. Wages are sticky. Workers got raises to compensate for inflation. Companies can't cut wages, so they pass costs to consumers. Inflation persists. Supply chains are still constrained. Deglobalization, geopolitical tensions, and underinvestment in commodities mean supply can't easily expand to meet demand. Housing costs are structural. Rents and home prices are set by decades of underbuilding. Monetary policy can't fix that quickly, so inflation is stuck above target. But at the same time, the economy is weakening because high rates are biting. Credit card defaults are rising. Auto loan delinquencies are up. Commercial real estate is in trouble. Regional banks are stressed. The Fed is caught. Inflation won't drop, but the economy can't handle sustained high rates. Now let's talk about what happens if the Fed makes the wrong choice. Or more accurately, since there's no right choice, what happens when they're forced to choose? Scenario 1. The Fed cuts rates to support the economy. Markets rally initially, stocks go up, bonds rally, everyone cheers. But within months, inflation reaccelerates. Why? Because the underlying drivers haven't been solved. Fiscal deficits are still massive, wage price spirals are still active, supply constraints persist. Inflation goes from 3.4% back to 5%, then 6%, then higher. The Fed realizes they made a mistake. They have to hike again. But by then, inflation expectations are unanchored. People expect sustained high inflation, so they demand higher wages, which causes more inflation, which requires even higher rates to break. Eventually, the Fed is forced into a Paul Volcker moment: rates at 10% plus to crush inflation completely. That causes a severe recession. Unemployment spikes to 8–10%. Stock markets crash 40–50%. Scenario 2. The Fed holds rates high or hikes further. Inflation slowly grinds toward 2%, but the economy breaks. High rates are already stress testing every leveraged part of the system. Commercial real estate has $1.5 trillion in debt maturing over the next 3 years at rates 2 to 3x higher than the original loans. Refinancing is impossible. defaults spike. Regional banks have huge CRE exposure. Some fail. Deposit flight accelerates. Credit freezes. Consumers can't handle 8% mortgage rates and 22% credit card rates. Spending collapses. Retail sales fall. Companies lay off workers. Unemployment rises to 6%, then 7%. Recession becomes obvious. At that point, the Fed panics and cuts rates anyway, but now they're cutting from a position of weakness, and the damage is already done. Both scenarios end badly. The only question is which flavor of crisis we get. Let's go back to the 1970s because this is the closest historical parallel to what we're facing now. In the late 1960s, the Fed kept policy too loose for too long to finance the Vietnam War and Great Society programs. By 1970, inflation was 5.7%. The Fed tightened. Recession hit in 1970, but they cut rates again too quickly, and inflation came roaring back, 7% in 1974. Fed Chairman Arthur Burns tightened again. Another recession in 1974-1975. Inflation fell, but not enough. By 1979, it was back to 13%. Paul Volcker became Fed chairman in August 1979 and decided enough was enough. He raised rates to 20%, crushed the economy. Unemployment hit 10.8% in 1982, but it worked. Inflation was finally broken. The cost, the worst recession since the Great Depression. An entire generation's economic prospects damaged. The lesson, once inflation becomes entrenched, the Fed needs to inflict serious economic pain to eliminate it. Half measures don't work. Gradualism fails. Only shock therapy succeeds. The Fed under Powell doesn't want to be Volcker. They want to engineer a soft landing, bringing inflation down without a recession. But history says that's nearly impossible once inflation is embedded above 5 to 6% for extended periods, and we're in year 3 of elevated inflation. Expectations are becoming entrenched. Wage price spirals are forming. The longer the Fed delays the painful medicine, the worse the eventual treatment will have to be. Here's the irreversible dynamic the Fed can't escape. The U.S. economy is now structurally dependent on low interest rates and continuous Fed support. Total debt, government, corporate, household, is over $100 trillion. At 2% average interest rates, pre-2022, the annual interest burden was manageable. At 5% average rates, current, the annual interest burden is crushing. Federal government interest payments, $1.1 trillion annually. Corporate interest payments, hundreds of billions more. Household interest payments on mortgages, credit cards, auto loans, massive burden on consumers. This level of debt simply cannot be sustained at normalized interest rates. So the Fed faces a choice: keep rates high, force deleveraging, trigger defaults, and recession. This shrinks the debt problem, but destroys the economy in the process. Cut rates, allow the debt to grow, inflate it away over time. This avoids immediate crisis, but destroys currency purchasing power. Both options lead to the same place: wealth destruction for holders of dollar-denominated assets. Option 1 destroys wealth through asset price collapse. Stocks, bonds, real estate all fall. Option 2 destroys wealth through currency debasement. Your assets might nominally hold value, but the dollars they're denominated in buy less and less. The Fed is choosing which form of wealth destruction to inflict, and the investors who understand this are positioning in the only assets that survive both scenarios: gold and silver. So, what does the Fed's impossible situation mean for you personally? If you're holding cash, you're betting on scenario 2. Inflation stays elevated, Fed eventually capitulates and cuts. In that scenario, your cash loses 3.5% purchasing power annually for years. If you're holding stocks and bonds, you're betting on a soft landing. Fed brings inflation down gently without recession. That scenario has maybe a 10-15% probability based on historical precedent. If you're holding a mortgage and other fixed-rate debt, you're actually positioned well for scenario 2. Your debt gets inflated away while your house appreciates in nominal terms. But if you're a saver, retiree, or fixed-income investor, both scenarios hurt you badly. Scenario 1, recession. Your stocks fall 40%, your bond portfolio gets hit as defaults rise. Scenario 2, sustained inflation. Your fixed income stream, pensions, annuities, bonds, loses purchasing power every year. The traditional 60-40 portfolio, 60% stocks, 40% bonds, doesn't work in this environment. In scenario 1, both stocks and bonds fall together, correlation breaks. In scenario 2, bonds get destroyed by inflation, while stocks struggle with margin compression. The only assets that work in both scenarios are real assets that hold value regardless of Fed policy: gold, silver, commodities, productive real estate, businesses with pricing power. Let's talk about what sophisticated investors are doing in response to the Fed's trapped position. They're not trying to predict which scenario plays out, they're positioning for both. Strategy 1, barbell portfolio, cash plus hard assets. Hold enough cash for liquidity and opportunistic buying when forced sellers appear, but hold the majority in hard assets: gold, silver, commodities, real estate, that preserve value through both inflation and deflation. Strategy 2. Reduce duration in bonds. Long-term bonds are extremely vulnerable to both scenarios. In Scenario 1, recession, credit spreads widen and defaults rise. In Scenario 2, inflation, bond yields rise and prices fall. Smart money is in short-duration bonds, 1 to 3 years, or floating-rate debt that adjusts with rates. Strategy 3. Focus on companies with pricing power. Not all stocks are equal in this environment. Companies with strong brands, monopolistic positions, or essential products can pass inflation to customers. Luxury goods, utilities, consumer staples, these sectors have pricing power. Tech companies with negative cash flow and no profits get destroyed. Strategy 4. Overweight gold and silver. This is the core allocation for dealing with Fed policy uncertainty. Gold works in both scenarios. Scenario 1, recession. Safe haven demand. Fed cuts rates. Gold rallies. Scenario 2, inflation. Currency debasement. Purchasing power preservation. Gold rallies. Silver works even better due to industrial demand layer on top of monetary demand. Smart money allocation, 15-25% precious metals, tilted towards silver for the leverage. Here's the moment of absolute clarity about what the Fed's dilemma means. The Federal Reserve has been the backstop for financial markets for 15 years. Every time markets fell, the Fed intervened, cut rates, launched QE, provided liquidity. Investors learned, don't fight the Fed, they'll always save the market. But now the Fed can't save the market without destroying the currency. If they cut rates to support asset prices, inflation reignites and the dollar's purchasing power collapses. They're trapped between protecting markets and protecting the currency. And historically, when central banks face that choice, they choose markets over currency. Why? Because market crashes are visible, immediate, and politically painful. Stock market down 30% gets headlines and costs elections. Currency debasement is slow, invisible, and easy to blame on other factors. Inflation running at 4% annually instead of 2% doesn't make headlines the same way. So the Fed will ultimately choose to cut rates, support markets, and let inflation run hotter than target. They'll find justifications. Inflation expectations are anchored. Core PCE is behaving. We have flexibility in our framework. But the result is the same. Currency debasement is the politically expedient path. And when that becomes clear, when investors realize the Fed will sacrifice the dollar to save asset prices, that's when gold goes parabolic. Because it becomes the only rational store of value when the central bank explicitly chooses inflation over stability. Here's your action plan for navigating the Fed's policy failure. Step 1. Accept that there is no soft landing. Stop waiting for the Fed to nail the landing. It's not happening. Either they trigger recession, hard landing, or they let inflation run. No landing, just continued elevation. Position for both outcomes simultaneously. Step 2. Build 15-25% allocation to precious metals. This is your hedge against both Fed policy outcomes, split between physical gold, 60%, physical silver, 30%, and mining stocks, 10% for leverage. Step 3, reduce bond duration to under 3 years. If you need fixed income exposure for income or stability, keep it short. Long-term bonds are a disaster in both scenarios. Step 4, shift equity exposure toward quality and pricing power. Sell speculative growth, unprofitable tech, anything dependent on continued low rates. Buy companies with strong balance sheets, consistent cash flow, and ability to pass costs to customers. Step 5. Hold some dry powder for forced selling events. When the Fed eventually makes their choice and one scenario becomes obvious, there will be forced selling and opportunities. 10-15% cash allows you to capitalize on those moments. Step 6. Stop listening to Fed forward guidance. The Fed doesn't know what they're going to do because they're reacting to conflicting data in real time. Their projections are worthless. Their dot plots are fantasy. Their press conferences are hopium. Watch what they do, not what they say, and position defensively until the path is clear. The Federal Reserve is trapped. If they cut rates, inflation reignites. If they hold rates high, the economy breaks. There is no third option. There is no soft landing. There is only a choice between which form of crisis to create. For 15 years, investors trusted that the Fed would save markets no matter what. But now the Fed can't save markets without destroying the currency, and they will choose markets over currency. They always do. Because currency debasement is slow and invisible. Market crashes are fast and visible. Politicians care about the visible crisis, not the invisible one. So the Fed will cut, inflation will persist, the dollar will debase, and the only assets that preserve purchasing power through that process are the ones that can't be printed. Gold, silver, real assets. The Fed has lost control, they just haven't admitted it yet, but the 13F filings from Video 11 show that the smartest money already knows. Druckenmiller, Dalio, Tudor Jones, They're not waiting for the Fed to figure it out. They're buying gold now, while the Fed is still pretending they have options, while the market is still believing in soft landings, while gold is still under $3,000. The Fed's dilemma is your opportunity. Position accordingly.